and gamma exposure would create more FTDs and further compound their problem within the time frame where that problem is created. Cat might break 210 this time. Kramer recently told boomers to buy. Son of a bitch. That means it's going to go down in like 3 days. If you were trying to build up more shares, how would you balance options versus buying raw shares? If I was attempting to increase my position in anything, I would probably be looking at, and I thought it was going up, right? Yeah, I'm assuming that you're bullish on the underlying. I would be looking at like far dated leaps at or near the money, probably at the money, and I would be probably, I would say about 10% of my capital into that, and then the remaining into shares. 10 to 20% of my capital into leaps, and then the remaining into shares. That's not a hard and fast rule, but that's like a kind of a general approach. Where do you like to go to look at options flow data? I like Shift Search a lot because it's free. Unusual Whales is fine. Both of those are pretty solid. There's some, free platforms and stuff that have a little bit of historical options data, but not a lot. TDA has it. If you want to try to scrub their uh, API, they don't like a lot of requests, so you have to kind of do it slow. But it's they have all the data for the most part, and it's mostly available. If you're trying to build up more shares, how would you balance options? Sorry, I answered that. So it's highly unlikely that we don't see any price action until the 20th of January. No, we have FTDs coming in on the 10th. ETF FTDs. I can show you out here. Do I have that open? Hold on, I have to open. Merry Christmas, Garrick. Here's to MOASS 2022. Thanks for everything you do. All the best to you and yours during the holiday. Cheers. Thank you so much, Dominic Joseph. All right. So there was something I thought about this morning that I guess I should address also. And maybe something that, we should have factored in or didn't factor into this is that Ryan Cohen's buy-in last year was right here. And so it may have reversed the trend of shorting this cycle down, right? And it may have increased the exposure that they had to cover going into this December ETF leap date, right? Um, and so, yeah, I mean, Ryan Cohen's buy-in last year may have had a substantial effect on the price action that we saw last year going into the December exposure period. It may not have, but as you can see, as soon as they start to fail, that's when the January sneeze began, right? That's when that anomaly window started, and it ran all the way through their fails, and it came down here, right? Um, and this was due to the cash settling of options. So as soon as people started cash settling their weeklies that expired basically right here on the 27th, 28th, the stock tanked right after that buy button got turned off and people started panic selling out of their contracts. They no longer had to hedge. They were able to flip their position and begin shorting. Had those options been further out, obviously these other FTD dates would have factored in, which they did not. We now have an FTD window from the massive amount of shorting that occurred during this time period. And it's hard to see because it's not scaled. 1 second, but we can expect this, basically this whole fucking thing. And it's some of the ETFs have ended up on the threshold list, but some of the larger ones that contain GME have still been shorted like crazy. They're just not enough to get on the threshold list yet, right? So like some of the like IJR and stuff like that is at like 50% short interest, and it's normally not super high, it's not like XRT where it's always got, 200 to 600% short interest. And so, we're going to see an inverse action of this when, those creations fail. And so even compared to last year's, and we don't really know how hard they borrowed from the ETFs last year. We're gonna look into it and see if this exact same pattern occurred last year and it was only upset by Ryan Cohen's buy-in. But ultimately, all of the creation here, unless it's covered, out here on the 27th, where we do have GME FTDs, by the way. I don't know how significant they'll be, but we do have GME FTDs on the 27th. That's actually our first FTD date. Those are FTDs created from the November run. But we don't know if this was the exact same thing that happened last year, but we're going to find out. If it was, then those FTDs obviously had an effect on last year's January window. If not, then there's even more FTDs this January than last January. You underestimate your importance in the GME saga. You're entirely right in your cycle theory, and short hedge funds can't let that show at any cost. They're almost out of options. Thank you for all you do. Thanks, Bones. I appreciate it. I'm glad you're bullish on my theory too. It's nice. Per your screen card, how much junk you got in your trunk? I got all kinds of junk in my trunk. No, literally, I need to clean my car out. How long before XRT is off the reg list? Who the fuck knows? It can be on there forever. Overstock.com was notoriously on the reg show threshold list for a few years. Thanks, Panda Dude. So it's highly unlikely we won't see any price action until the 20th of January. I answered that extensively. Okay, sing it with me, kids. Thoughts on slow cookers? I like mine more than my 150 Febs. Are we pricing in the NFT marketplace? Fuck no. How safe are April 250s? Safer than February 250s? Follow up. That means that delta sensitivity spike could be what scares them into shorting, causing the FTD pileup from that date. Yeah. The theory allows for it to go up, down, or sideways. Yeah, it does. The theory is more like an experiment at this point. The wheels seem to be in the motion. The idea behind the theory was to create a framework to understand their manipulation, right? it wasn't necessarily created to predict the effects of that manipulation. It does. Um, but it was created to create a framework on which we like a lens which we could view GameStop and understand what the fuck is going on. Um, and it does that, when we have these periods, we have an immediate effect. Whether we run or we don't run, we have a noticeable effect in direct correlation with that period of time, right? So, we expect exposure on the 17th of December and they short the fuck out of the stock in advance, right? And while it may not be the movement that we want, obviously, because we want to make money, it is a relevant movement when they're spending billions of dollars shortening an entire sector into a specific date. And that allows us to explore more possibilities for why they're doing it, how they're doing it, right? And so we can look at the options chain and we can look for in the money puts. We can look at the ETFs and look at the amount of shares being borrowed per day. We're triggering things that are highly unusual, like ETFs being added to the reg show threshold list, and it's not like there's no effect defined, right? The effect is what it does is allows us to narrow our search instead of just sitting there and going, I don't know, they just shorted the stock 40% in a couple of weeks and now it's dead. Which is what they want us to think. Now we understand that, there's no way to do that without using the SEC lending pool that doesn't create FTDs. I appreciate the fact that you treat variations in your predicted price actions as opportunities to learn more instead of getting discouraged. I'm more excited than ever for what January has in store for us. Merry Christmas. Merry Christmas by Polar Bear. Thank you, man. Follow up. That means against. Theory is more like an experiment at this point. I don't think they like those 1.1K at 155 Cs. Probably not. In January 21, there are 136,000 puts at 50 cents. What does it mean? Are they hiding the FTDs? So, for a long time, people thought that they were hiding the FTDs by using a married put calls. So, essentially, marrying a put and call contract, exercising to create shares, and then using those shares to satisfy FTDs. We don't have any evidence of call side open interest equivalent to that put interest. We do have evidence that those are the exact puts needed to hedge a variance swap. And to hedge a variance swap, they created a replicating basket of options contracts that track the variance and effectively hedge against their variance swap position. If you want to know more about that, you can check out Zinco 83's DD variance volatility and dispersion. Oh my. It really goes deep into the variant swaps, how they're being used, and the relationship between them and the replicating baskets. Was August FTDs or GEX? GEX. Burry was further out. I think Burry was out of GameStop when Ryan Cohen made his second purchase. But Burry caused the share buyback that likely trapped a significant chunk of the short position underwater. Will the FTDs be as plentiful without RC buying? I mean, based on the amount of synthetic shares created in ETFs over the last 2 weeks, I would say the FTD should be pretty plentiful. If you can't exercise, but say you can buy like 30 shares after you sell your call, Is that like exercising in terms of pushing them into the buying market? Yes. Right. The beauty of exercising, even if you're only capturing a small amount of the available shares in your contract, is that those shares can't be satisfied with bona fide market making. So if you buy a share at market, uh, through your brokerage, the market maker will make you a share, and probably create an FTD. But if you exercise a contract, the uh, the seller of that contract is supposed to have it hedged, and they have to get a share for you. And ideally, that's occurring at a moment when shares are very scarce. Clip, clip, clip. I don't know.